So if you're looking to trade with confidence on the higher time frames and develop a higher time frame bias strategy, then this video is for you. So in this video, we're going to be going over market structure, dealing ranges, premium and discount arrays, and fair value gaps. This is what I call the 4-pillar approach, and it is the easiest, most practical, and simplest way to form a higher time frame bias that works in Forex, futures, commodity, and even the crypto market. If you're struggling with a higher time frame bias, or you just need a little bit of extra tweaks and refinement to find exactly where the session is going to go using the higher time frames, then this video is for you. So with that being said, let's dive into it. When we trade on the higher time frame, this is the S&P 500 on the 4-hour chart, right? So I always use the 4-hour chart when I start my analysis, and the reason for that is because the 4-hour chart gives you the cleanest indication of higher time frame structure, higher time frame key levels, and higher time frame fair value gaps. And so the 4-pillar approach, right? One of the most important things I teach in trading, right? So you need to understand the market structure, right? This is basically the highs and lows of the market, right? One of the most organic, one of the most overlooked concepts in the markets, right? After that, you want to understand your dealing range. And the dealing range is the most recent high and low in the range. After that, you want to be understanding your premium and discount arrays. So you want to understand anything above the 50% is a premium, anything below is a discount. And the fourth thing, last but not least, you want to understand fair value gaps. And the main thing you want to understand with this 4-pillar approach is that it's kind of like a domino effect, right? Market structure will lead on to the dealing range will lead on to the correct premium and discount arrays. And from that, you can then identify fair value gaps. And the reason we identify fair value gaps is that they lead us to what we call points of interest, right? So they lead on to POI. Right? Some people refer to them as supply zones. Some people refer to them as supply and demand zones. Some people refer to them as POIs, but eventually these lead on to supply and demand zones. I'm just going to write S and D zones like this. And so once you have your supply and demand zones, you want to treat them as magnets, right? And we're going to get into this in a lot more detail. So with that being said, let's put this over to the side and let's understand how we do this, right? So how would I mark up this chart on the S&P 500, right? So I want to start off by looking at my market structure. And so market structure itself, one of the most overlooked concepts and one of the most overcomplicated concepts, but it doesn't need to be, right? So let's actually go back to the left-hand side and let's start from the top. So market structure itself organically is just the highs and the lows, right? So if I start off here right to the left of your screen, we have a structural high. We have a structural low like this, and then we have a structural high. Notice how every single market structure break will happen with a body, right? So this is a body break over here. This is our first kind of market structure break. We are bullish so far in terms of our market structure. Now from here, we had a break over here, right? So we had a nice break over here. And now from here, we have somewhat of bearish structure. So we have a structural high, structural high, and then we've broken down here. So we have a structural low, then we retrace up into a structural high, and then we have a structural low over here. Now I'm going to speed this up a little bit. So we have a break of structure over here. So this is going to be our structural high, structural low, structural high, and now we've broken structure over here. Boom. So now from here, we're going to stop and go to number 2, right? So step number 2 is essentially the dealing range. So the dealing range is the most recent high and low of the leg. So let's replay price a little bit and let's go down to here. So a dealing range is essentially the most recent high and low. So to make this nice and clear for people, let's mark this out. So this is going to be your dealing range high up here, right? And this is going to be your dealing range low. Dealing range low, dealing range high. And anything in between is what we call internal structure. And inside of that, we have internal liquidity, we may have external liquidity, and we have fair value gaps, which is something we're going to get onto. But once you have your dealing range, you are simply projecting the Fibonacci tool from the swing high, down to the swing low like this. And so this is essentially our dealing range, from the swing high down to the swing low. And so step number 3 now, PD arrays. And so PD arrays come directly from the dealing range. And so the dealing range is important to understand because the dealing range gives us our fair value gaps and therefore our POIs. There's 2 types of POIs in the market which I want traders to understand, right? The first of those is a supply area. And we are going to go through what a supply area actually means. So a supply area is essentially a fair value gap that is above the 50% area, i.e. in a premium. And so a premium will look something like this. So we're above the 50% area and we are looking for fair value gaps above the 50% area. So what we can see over here, I'm going to mark this out. This is an inefficiency I'm going to label in blue. So this here in blue is a fair value gap, and it's a valid fair value gap because we are in the premium. Now from here, we have another fair value gap all the way up here. So if I move that out of the way, we have another fair value gap that starts at this wick and finishes at this wick. So this is our second fair value gap within the premium itself. Okay, now from here, we've done our 4-pillar approach up until this moment in price. And so we have a couple of things to look at now. We need to look at supply zones and demand zones, right? Let's start with supply zones. What is a supply zone, right? So a supply zone is essentially a bearish point of interest. It is a bearish POI. And the reason it's a bearish POI is because of 3 things, right? A bearish POI needs to break structure. It needs to be priced in the premium, and it needs to leave a fair value gap, right? These are the 3 rules to any valid POI. And so from here, our POI is going to be the last candle before the fair value gap. So I get a lot of questions about how I mark out my POIs. POIs are fundamentally different to fair value gaps. However, they're very, very closely linked. And the main difference between a POI is essentially a POI has 3 rules to them, which is what you can see on your screen, right? We need to break structure. So we've broken structure like this. We've had price breaking over here. We're in a premium, so we're above the 50% area. And most importantly, we've left a fair value gap. The fair value gap is the most important concept because we know as a trader, the market gravitates towards 2 areas. Anyone who's traded ICT understands the market gravitates towards 2 areas, right? The market will gravitate towards liquidity and fair value gaps. And so we have a fair value gap over here. We have a second fair value gap over here. We also have a ton of liquidity over here, trendline liquidity, internal range liquidity, whatever you want to call it. The market will gravitate towards these 2 types of areas, fair value gaps and liquidity. And so from here now, if we continue to play price on a little bit, we can see how price attempted to head higher before we had the ultimate breaker structure to the downside. And so from here now, we need to understand a couple of things, right? Let's clear up the charts and see what I mean. So if we go to most recent price action, we can see the same thing, but from a bullish perspective. And so from here now, the way that I would again start off by looking at structure, the most important thing is structure. Our market structure is as follows, right? We see price giving a structural high. And then if we zoom out into the markets, we see price giving a low all the way down here, right? So this low is all the way down here. And so why is this important, right? Why is it important to understand this? So this is our dealing range, right? This is the dealing range that we're currently in, right? So this is a structural high and this is a structural low. And so from here, if I continue to move this out, we've had a break of structure to the upside. And so now we've seen a shift from bearish structure up to bullish structure. Okay, so now we're bullish in terms of our market structure and we're above an old high. And so this is where market structure and dealing ranges and fair value gaps start to correlate with each other, right? You need to use all of them in conjunction to make an informed higher time frame bias, right? So again, what's going on here? If we go back to our previous dealing range, we had 2 points of interest over here. Now, again, these are valid points of interest because we're above the 50% area. We're above the 50%. We're in a premium. And so when we're in a premium, this means that we should be looking for these fair value gaps to potentially have a rejection of. And that's exactly what's happened over here. So we had a very, very clean rejection of this area. So for those who are wondering why the S&P 500 or the ES, right? ES S&P 500 in the New York session gave us those sells, this is the exact reason why, right? This is a POI, this is a supply area. And so when you come into a higher time frame supply area, you really want to be mindful that the market could reverse. And that's exactly what's happened. So when you look at a supply area like this, you want to think, okay, where are we in price? When you want to form a higher time frame bias, you always want to ask yourself, where are we in price, right? So let's kind of answer that question with a schematic over here, right? So when price moves higher or when price breaks structure to the upside, right, the market will typically do this. We will head higher, then we'll have a retracement. Then we'll head higher like this, right? So we are now above an old high, right? What I mean by that is this is the old high and we're above the old high. So now we're in a position where we're above the old high like this. And also to give us extra confirmation, we've tapped into a higher time frame fair value gap, right? So we've tapped into a higher time frame fair value gap. So what's happened here is we have broken structure and we're above the previous high, right? So we have taken out this previous high just like this. Now from here, we want to ask ourselves, let's use the Fibonacci tool to our advantage, right? How do you use the Fib tool in a simple way, a systematic way, and in a reliable way? And you do that by simply using the 50% area. So you don't need the 71 area, you don't need the, whatever the numbers are, 78, 61, you don't need any of those numbers. You simply need to understand your market structure on the higher time frames, then you need to understand dealing range. And so our dealing range right now is of course from this structural low down here, all the way to this structural high. So let's quickly mark that out on the charts. And this will help us determine an overall bias. So now we've come into this, and now we've had some kind of a pullback. For those who are unclear about a pullback, you want to have at least 2 candles for a pullback, and ideally you want to be looking for sharp moves and sharp pivots up and down in the market. So what I mean by that is this was a sharp move up, before going down. This was a sharp move down before going up. Same here, we had a sharp move, and also same here, we had a sharp move, right? So this is what you're looking for in the market. You're looking for reversals, pivot points, but the main thing to understand is you don't force these points. You allow the market to pull back with at least 2 candles before projecting the Fibonacci tool, because I see a lot of traders messing up on this. They try to force trends, they try to force things that are not even there. You don't need to do that. What you need to understand is where the dealing ranges are based on what the market gives you. And so right now we're in a dealing range, right? This is the dealing range low, and this is the dealing range high. Again, to make this very simple, the dealing range is simply the most recent swing low and the most recent swing high. That is simply what the dealing range is. And so from here now, how can we understand where price is likely to go? So the way we do this is by understanding that we are in a premium, we're way above the 50% area. And what we want to do in the high time frame is start to look for fair value gaps, start to look for POIs, right? Very important to understand that. And so now from here, we're in a position where price on Friday was pretty bullish. We ended the week bullish on the S&P 500 or ES. Now we have a gap over here. So I'm just going to start marking this out. So we have a gap over here. Let's label this in blue. This is a gap, right? We can treat a gap as a fair value gap. The market could react off this gap. We have reacted off this fair value gap. And we also have some fair value gaps down here as well. So this is price also leaving a fair value gap. And so from here, right, there's a couple of things that we can expect from here at least, right? So if price stays below this fair value gap over here, so this is the fair value gap you want to be looking for. This is the supply area. If price can stay below this area, right, you want to be looking for shorts, right? We are bearish. So if we can stay below here, we are bearish. And we can be bearish potentially all the way down to this region, right? We can be bearish all the way down to here. So on the S&P 500, around 55.74. So what's going on here is we want to use premium and discount and fair value gaps together to form a higher time frame bias. And so we have respected this fair value gap. However, if we can stay below this fair value gap, then we can definitely fill this fair value gap, potentially down to this fair value gap. So this is my next kind of target on the S&P 500. So provided we stay below kind of this area, so 59, what's that going to be? 59,800, 59.80, 59.70s. If we can stay below this kind of area, we can expect lower prices because we also have some liquidity over here. So the market's target fair value gaps, the market's target liquidity. So if you can understand these two things as a trader, you can increase your strike rate by simply knowing what the higher time frames want to do. One of the most important things is understanding what the higher time frames want to do. So this is really important to understand, right? So we've looked at the bullish fair value gaps. Now let's look at the bearish fair value gaps, right? So we have a bearish fair value gap resting just over here on the S&P 500 created last week, right? So this candle's low and this candle's high didn't touch. So this is a fair value gap. And so our point of interest or our POI that we're going to be looking for is going to be this region. So it's just the candle before the fair value gap. Now, again, I get a lot of questions about this. So I'm going to hopefully answer this. The reason we choose the candle before the fair value gap, right, is because we want to see price coming into the entire candle before, which means it's essentially filled this fair value gap, right? So we want to see price filling this fair value gap before heading lower, right? That's basically how this works. If we respect this POI and price fails to break above it, so if we stay below this area, then yes, I am bearish. And I'm going to be bearish all the way down to probably, like I said before, I'm going to be bearish down to at least this particular area. So this is now 57.15, right? So when you're choosing a higher time frame bias or you're looking to determine a higher time frame bias, the way you do it is by looking at the 4 pillars, right? So we're going to quickly sum this up. So the 4-pillar approach, right? The 4-pillar approach starts off with market structure. So we are bullish on the S&P 500. We've broken the previous high. And so we are bullish, right? We are in this particular area over here, right? So if I draw this out again, we've broken structure, but now we're above an old high. So we can reasonably anticipate a correction above this high over here. But now that we're in a premium and price is now heading very, very rapidly towards this fair value gap. If we can hold this fair value gap inside of a premium, we can expect lower prices. And this is how I form a high time frame bias, not just on the S&P 500, but on any market. Now on the daily time frame, right, which is something I don't use that often, on the daily time frame, if we look at this, so on the daily time frame, we have runway, right? We have some runway definitely for higher prices. So again, on the daily time frame, I'm mainly looking at fair value gaps. Now we've had efficient pricing all the way up to here, and price has filled this fair value gap. We can see price has respected this fair value gap pretty neatly as well. And so if we've tapped into this fair value gap on the daily, right, if we can stay above this area around about the 57.50 area, our next target is going to be, without a doubt, this fair value gap up here. And so this fair value gap is at 60.58, 60.60 area. And so realistically on the daily, I do expect price to come up to here. So on the daily time frame, I am bullish. However, you don't just want to use the daily time frame, especially if you're an intraday trader. You want to understand 4-hour fair value gaps and 15-minute fair value gaps before using the daily time frame, in my opinion. So from here now, if you look at it from a daily perspective, now that we've filled this fair value gap, right, the next overall target, if we break above this area, this fair value gap, is definitely going to be this fair value gap over here. And so to sum up this video, the way you form a higher time frame bias correctly is by using two concepts: fair value gaps and premium and discount arrays, right? So price always moves from one fair value gap to the next fair value gap, targeting liquidity along the way. But the way you determine accurately whether price is going to be buying or selling, whether price is going to go up or down, is by pairing it with the 4-pillar approach: market structure, dealing ranges, PDAs, and fair value gaps. So don't take my word for it. Go and backtest this on every single market: forex markets, futures markets, gold, crypto, anything you want, right? The 4-pillar approach will work and give you clarity on the higher time frames in any market you choose to trade.